Hello, everybody. Welcome to another video of our Southern California housing market update. This is for April 27th, 2021. My name is Stephen Mead with Domicile Real Estate. Real estate for people who love houses. And this week we're going to go through the stats, and then at the end I'm going to talk a little bit about the top of the market and what I think that means and whether I think we are there or not. So we also have a new graph this week that I think is kind of interesting. So I will show that off as well. So without further ado, let me jump into the stats. I think I only have about 15 or 16 minutes before I get to jump on another fun Zoom call. So let's start this off here, heading back to the beginning, right? So this is our total active listings in the market. And really, I think this is a great way to start off with what's happening here. As always, we have divided this into under $1 million, and then our red line indicates $1 to $2 million. So we really try to bifurcate the price ranges, because I think when you're in a rising market like this, that really is what's sort of altering. I think that's really where the dividing line is in this market. I think people over $1 million behave fundamentally different than people under $1 million, and that those markets are related but not really the same. And just as a reminder, our data is for Los Angeles and Orange counties here in Southern California. So if we look at our total active listings, I think this really tells the whole story of what kind of spring we've had. There has been no inventory bounce. We've had a couple minor moments where inventory rose, but the reality is inventory has remained fairly constant. Unfortunately, what has not remained constant, though, is people jumping into contracts and demand. So if you have your number of active listings remaining constant, but you have increases in demand, that is going to result in a shortening supply of homes when you measure that in time. Like when you hear people say, how many weeks supply of houses do we have? Well, even if the number of houses you have is available is, say, 1,000 houses, if every week it goes from 200 of those going to contract to 500 of those going to contract, you've just seen your inventory drop from 5 weeks of inventory to 2 weeks of inventory. So we've just never really seen these numbers get up there. We are about to head into May. I feel like if we haven't had a big inventory push, barring something big changing in the market, I don't think we're going to see it. So if you look at our 14 days of new listings, I think this really kind of hits the nail on the head. Back here in January, we saw this steady increase of new listings coming to the market, and then look what happens. It just stopped increasing. Around the middle of March, we just sort of stopped that upward march that we had in our statistics. And what you see here is, this inventory has really just stalled out. We got what we were going to get. Anybody who was waiting to put their home in the market, gosh, by the middle of March, that level of supply was in full swing. We actually saw a drop off the last week. We've seen a drop off in our under 1 million. Things have been a little bit more constant over here in our 1 to 2 million category. But even here, we saw a slight decline. This is just not the kind of market really that is going to lead to this sudden change in that supply and demand relationship. We're definitely not really seeing anything change in the supply argument, right? And then now, if we look here for our new escrows, and it looks like we might actually have an error in our graphs this week. I'm just noticing this right now. I will have to actually go in there and change that for you guys. You know what? Let me take a second here and talk about something else. I was going to talk about this at the end of our presentation, but I think I'm going to go ahead and do it right now and see if I can't fix this slide for us. We have a little bit of a mistake in there. I try to be perfect, but that's not always possible. So what I wanted to talk about was really trying to understand whether we are at a point in the market, whether we have hit a top of the market or not, whether we've actually hit something and we've hit sort of a relative peak. And I actually don't think we're there. And there's a couple reasons why. I think there's a lot of reasons that affordability can get worse before it gets better. And I'll talk about that here in a second, what I mean by that. So if you're talking about the way people make decisions on buying houses and what affordability really means, The fact is, affordability is driven by payments, and it's not really driven by nominal prices. This is the reason why markets are so reactive to interest rates, because at the end of the day, this is how people budget when they're buying a house. They are looking at that number. How much do I have to pay per month? And the reality is that number really isn't that bad for us. And I'm going to jump around. I normally do this in a very structured manner, but now that I noticed a mistake in the graph, I'm kind of annoyed and irritated. So I'm going to change sort of the um, the order that we're doing here. I'm going to jump down to our affordability number. So this is the chart of how much is the payment on a median priced home. And if you look back here, June of 2018, we are at 100%. So this is showing that number relative to June of 2018. And what you're going to see here is throughout 2021, this sort of steady increase, right? And what is that? That is prices going up. But look what happens here. We sort of reach this peak number around 115% of that 2018 number. Now, the reality is, and I've said this on a couple of occasions before, that's not really that bad, right? Like that means we've gone almost 3 years to see a 15% increase in payments. That's not really a huge increase in payments over a 36-month period. But look what happened in the last few weeks as interest rates have dropped. And the way interest rates have dropped, I have another little chart to talk about that we are adding. What it means is we've actually retrenched, almost 5%. So the reality is, as of this week, if you are going by median closed home prices, and I think it's really important to understand this, we are in a market that is moving relatively quickly. And I've talked about this before. We have week to week market movements. When you are in a market that moves week to week, it means that your sold data is a bit unreliable. And it's not unreliable in the sense that it's bad, it's unreliable in the sense that it is dated. So any of those median home price data that you see quoted, that stuff's 4 to 6 weeks old. It's not current market conditions. And we don't really have access to those current market conditions in a meaningful, reliable way. At least we don't have direct numbers. We have to look to indirect things like what's the absorption rate? What are these current statistics we can calculate? So the reality is, I actually don't think this affordability has gotten 5% better. What I think has happened is it has flattened out, but home prices have gone up to meet those lower interest rates. I think that's what's happening in our market right now. And the reality is, I don't think 115% is this ridiculous number. So when we're talking about, when we're talking about how bad can it get, right? Like in terms of affordability, can it get worse than it is? The answer to that is, I think yes. Yes, affordability can get quite a bit worse than it is right now. Affordability can absolutely deteriorate from the point that it's at. And if we see inflation, that actually may cause a situation where we are driving home price increases even further. And that may actually fuel the market a bit more, right? Especially if there's some wage growth to accompany that. So when buyers are on the sidelines and they're saying, this market is nuts, it feels like a circus, it feels like a frenzy, I totally get that. In fact, it feels awkward, it feels uncomfortable, it feels like this is not sustainable. But the reality is, our affordability is not deteriorating that quickly, at least not as quickly as home price increases might suggest. And that's the reason why this market could still continue to have deteriorated affordability. So, okay, I'm going to jump back in. Talking about those interest rates, we do this here. Look at what happened, right? We see interest rates have dropped from that 2018 number. So this is over the same period of time. And then if we starting here in 2021, look what happened. They start going up and increasing like this. And what's interesting is if we go back, right, and we look at sort of our price stuff here. Let's go back and look at our price chart. So if we look at our price chart, you can actually see that there's a little bit of correlation here, but it's delayed, right? Like, so the things that happen here are reflective of things that were happening over here, if that makes sense. I really should create a graph to overlay these. So let me jump back in order. I normally go in order and I like going in order, but that chart that was a mistake kind of is now irritating me. So if we look at our absorption rate, right, and we track this over time, this is sort of one of our immediate market indicators, like I mentioned. This is one of those things that talks about exactly what is happening this week in the market, not 4 to 6 weeks ago. And look at where we are for both of these since the last 3 weeks as interest rates have dropped. That absorption rate has increased in both categories. That you'll notice that increase is more pronounced in our under $1 million. Why? Because buyers under $1 million are more sensitive to interest rate fluctuations. So if you look at this, it's really not hard to see what's happening. You know, we had higher rates, and as interest rates went up, we saw these rates kind of go down a little bit. But then as soon as these interest rates ease, right, boom, absorption rates start going back up. Now, there are a lot of variables that factor into these, so there's not always direct correlations, but I'm not at all surprised that our latest market movements, if it feels like it's gotten nuts out there, it's because the rates are lower. If we look at our closed prices, again, these are 4 to 6 weeks old, look what's happening. Sort of flat in both our 25th percentile and our median. So our entry level and our median prices, these are both under $1 million. But boy, look what happened in that 75th percentile. Those prices kept going up. Why? Because those markets are less sensitive to interest rate. So if we look at another one of our sort of like immediate market indicators, we actually get a little bit of a mixed result here. So we see that our $1 to $2 million, this is our percent still active after 14 days. Our 1 to 2 million, that number actually rose a little bit, but we've seen some reductions on our under $1 million. That means that market is getting more competitive. If we go to our list close ratio, again, this is 4 to 6 weeks old. I'm actually a little bit surprised by these numbers. I kind of thought we had hit sort of peak overbidding when we start to see these numbers hit that 103% mark. But look, both of them in the last week rose. Again, though, this is based on 4 to 6 weeks ago's numbers. It is not based on present sale data. So this is looking into the past a little bit. Finally, we have our days on market for new contracts. And you know, just when I said I didn't think our under 1 million could go any lower, we dropped a day. Look what's happening here to our 1 to 2 million. Those are starting to get snapped up. I mean, to be in the 20-day market for a prolonged period in homes that are $1 to $2 million, this is nuts, people, right? Like this market is crazy. And this is very much driven by pretty simple supply and demand. And that is, we just don't have enough houses. We have never gotten an influx. And here's the crazy part, right? If you are a seller in the market, I'm going to say something different than any other real estate agent who's probably out there. Every other real estate agent, it's a great time to sell. Yes, that is technically true. But if you are a seller, you really have to think about your whole situation. You have to think about where you're going and what you're doing. If you are a seller who is looking to move up in the market, yes, it is a great time to sell, and it's a pretty decent time to buy because interest rates are low. If you are a seller looking to downsize, that picture is a little less clear, right? Because you're not able to sort of take advantage as much. The low interest rates, locking that in isn't quite as important for you because you are reducing your loan amount, presumably. And if you are a seller who is looking to rent for a while, I would say now is not a very good time for you to sell because I think you will see your affordability erode in that time period that you are waiting. Anyhow, I know this one is a little bit weird this week. Sorry we jumped around a lot. I hope you got some value out of it. Do not forget to like, subscribe, hit that notification bell. We love questions, comments, and definitely reach out to us if you're looking to buy or sell in Orange County and you'd like a realistic take on your situation. That is the kind of advice that we give. We tell you both sides of it, the ways it can go right and the ways that it can go wrong. Anyhow, we will see you again this Friday for our entry-level home buyer market update. We will see you again soon.